Welcome to Stocks Review. Click the subscribe button for more up-to-date stocks and portfolio review. Today we are going to take a look at ServiceNow. Stock ticker symbol NOW. It is headquartered in the USA and service regions all around the world. You may ask why we should care about where the company is headquartered? This is because companies in developed countries tend to be better regulated, whereas companies in developing countries tend to have higher growth, but also more risk. Companies that are headquartered in authoritarian states also have higher political and regulation risk. The service region may give us a clue of the company's overall stability and long-term growth potential. It has a market cap of $98 billion and is considered a large cap company. The market cap is an important metric because companies with larger market cap often have more pricing power, liquidity, and lower failure rate, whereas companies with smaller market cap tend to have more growth potential. What sector and industry the company is in greatly influences its ability to deal with market uncertainty. It is in the information technology sector and software industry. ServiceNow provides enterprise cloud computing solutions that defines, structures, consolidates, manages, and automates services for enterprises worldwide. It operates the Now platform for workflow automation, artificial intelligence, machine learning, robotic process automation, performance analytics, electronic service catalogs and portals, configuration management systems, data benchmarking, encryption, and collaboration and development tools. The company also provides multiple cloud-based IT service management applications and solutions. It serves government, financial services, healthcare, telecommunications, manufacturing, IT services, technology, oil and gas, education, and consumer products through direct sales team and resale partners. It has a strategic partnership with Celonis to help customers identify and prioritize processes that are suitable for automation. In short, it is a cloud-based management solution provider. Despite its recent drop, it has a 5-year price return of 456% and significantly outperforms the SPY. The 5-year price chart may help us evaluate how a company performed recently and its ability to weather global events, such as trade war, pandemic, and supply chain issues. It has a 5-year compound annual revenue growth rate of 33.5%. The revenue growth is consistent and the revenue trend looks very strong. The revenue trend is important as growing companies often have sales go up first, followed by profit growth. On the other hand, when sales become stagnant, it may also give us a hint that the growth phase of the company may come to an end if no critical change is made. The net income has just turned positive recently. The net income trend looks very good, as it can grow its profit consistently. The net income is one of the most important metrics an investor should be aware of. In the long term, stocks always follow the earnings trend. It has been issuing more shares in the recent years, probably for funding its growth. We should always follow closely if a company is buying back or issuing more shares, as both of these activities greatly impact the return shareholders can get. It does not pay a dividend yet. The dividend history gives us a peek of a company's cash flow stability. The overall shareholder return of ServiceNow is very good and significantly outperforms the historical performance of the SPY. The total return and annual growth rate history of a company can show us what the performance trend was and how it had navigated through difficult times. Most companies tend to perform similarly, with a slight decline in growth as time goes by. ServiceNow has a 10-year total return of 19.95% with a 10-year compound annual growth rate of 34%. If you had $1,000 invested 10 years ago, you would have $19,950 now. Currently, the price is at around $491 with a 52-week high at $707 and 52-week low at $448. It is near the lower end of its 52-week range. It has a P/E ratio of 427 and forward P/E ratio of 69. It has a cash position of $1.7 billion and long-term liabilities of around $2.1 billion. The ratio of cash, debt, and market cap may help us evaluate the default or bankruptcy risk and what percent of your share is eroded by debt. Higher debt also has a higher cost in an elevated interest environment. ServiceNow is considered a wide moat company according to Morningstar's rating. Now, about the future projection. Currently the margin is 3.9% and future margin after 5 years is expected to be 33.2%. The margin is expected to be increasing a lot after 5 years. The company's margin and moat reflects the pricing power of the company, and the projected trend is also important. We want to own a company that is able to stay profitable and relevant. It has a 5-year forecast revenue compound annual growth rate of 21.8% and 5-year forecast EPS compound annual growth rate of 25.6%. The near-term growth is expected to be very good. It has beaten all of analyst consensus EPS estimates in the last 4 quarters. Looks like it's on the right track to success. The overall analyst recommendation rating is a buy with trend shifting towards buy recently. The rating trend gives us a clue of the changes of what analysts thought about the stock. Out of 32 analyst 1-year price targets, the range is 460 to 850 with an average price of 674, which is well above the current stock price. The discounted free cash flow model is a widely accepted method for valuing a company. Here we present 3 kinds of discounted free cash flow model results for a more comprehensive review. If we run the DCF perpetuity growth model, the fair price is 521 with an upside of 3%. If we run the DCF terminal EBITDA model, the fair price is 460 with a downside of 9%. If we run the DCF terminal revenue model, the fair price is 514 with an upside of 1.7%. Now we compare ServiceNow with U.S. Treasuries and SPY. It cannot be emphasized more that the U.S. 10-year Treasury yield is one of the most important numbers to keep in mind when investing in stocks. The 10-year Treasury yield affects the valuation multiple of stocks like gravity. The higher it is, the lower the stocks are valued, including all the S&P 500 companies and all the stocks in the world. Currently, the 10-year Treasury yield is around 2.9%. The SPY is considered one of the safest and most liquid ETF for investing in the stock market. Big funds and investors directly compare the risk and return of investing in SPY or in individual stocks. The historical return of all stocks follow the earnings trend long term. However, the real return is often reflected by a mix of dividend and buybacks together with revenue or profit growth affecting the valuation. The return yield of SPY at around 10%. The SPY has an average forward PE around 18.8 now. ServiceNow has a dividend plus 10-year growth forecast plus shares buyback yield at 8.5% and a forward PE around 69. We have to be cautious that this is just a rough prediction of ServiceNow future performance. The forecast can be changed at any time, and the actual revenue or net income the company is able to get depends heavily on the true market condition. Looks like ServiceNow is more expensive than the SPY, and SPY looks like a better buy with a more stable return estimate. We will try to summarize all information above to give us an overall impression of ServiceNow. In summary, ServiceNow is a large cap good company with good growth and wide moat, and probably overvalued now. If ServiceNow can grow at a faster pace surpassing estimates as it usually does, then it may be a good buy and hold long term. Now that's a review for ServiceNow stock. Click the subscribe button for more up-to-date stocks review.